Good morning, everyone. My name is Jonathan Vinokur. I'm an attorney at Thompson Hine in Cleveland, Ohio. I spend all of my time working with early and growth stage technology companies, which is why I've had the chance to, or I get the chance to talk to all of you, and in particular these four individuals. We're going to start off today with just a brief introduction from each of our panelists, and then get into some questions, and then go from there. With that, Morris, could I actually ask you to start, and then we can just go around the room as it is.
Sure. My name is Morris Wheeler. I am the founder and principal of Drummond Road Capital, which runs a series of venture funds that began in 2009 or so. We've made over 100 or more investments in direct investments in early stage venture companies over that period of time. And I have served in every role from investor to I founded an internet company, actually several internet companies over time, as well as running a small public industrial company for a period of time. And I've been through a couple of these rough spots over those years.
Thanks, Morris. Yvette, let's go to you. That's the order on my screen anyway.
Hello, my name is Eva Rodriguez. I'm a principal with Cultivation Capital. We're an early stage focused VC firm, primarily in B2B SaaS startups, anywhere from pre-Series A up to Series A. I always like to say by Midwestern standards. I've been with the firm for almost 5 years now, and previously I've worked with Accelerator, so I've seen anything from Accelerator stage up to the Series A stage.
Great, thanks. Rem?
Good morning, Rem Harris. I'm with Jumpstart. Jumpstart is a venture development organization in Northeast Ohio. We operate 3 different funds, 2 $10 million seed funds, one $20 million Series A co-investment fund, primarily focused on investing in Northeast Ohio and throughout the state of Ohio. I've been with Jumpstart for the past 13 years out of the 15-year history for the organization. And over that time, we've put out about $60 million in capital into about 125 companies across the state, primarily investing at the seed stage, doing a little bit of Series A investing as well.
Thanks, Rem. And Bill?
Sure. Bill Baumel from the High Innovation Fund. I actually started in Ohio, grew up here in Cincinnati, went to Ohio State, went out to Silicon Valley for about 20 years, investing in med tech and tech companies, and then formed the Ohio Innovation Fund back about three and a half years ago. We are Series A investors in both med tech and tech companies throughout the state. We've actually co-invested with Rem and Jumpstart a number of companies, Complion and Employee Stream up in Cleveland. We're both in Aware down here in Columbus. And as I mentioned, we invest across the board. So we've invested in cybersecurity, data science, SaaS specific to certain end markets such as med tech. We have 1 or 2 med device companies and have 2 or 3 biopharma cell and gene therapy companies.
All right, great. Thanks, everyone. So I'm going to actually start, go back to the beginning here, and Morris, start with you as sort of the person on the panel representing the angel investing community. Could you just give us really high level sort of what you're seeing from a deal flow perspective? Is there none? Do the pitch decks keep coming? Is the, are the sort of the accelerator feeders positioning differently, and so that's adjusted deal flow? And then take that into sort of what you foresee a typical, or what your diligence process has been throughout.
Okay, so let's start with deal flow. I think our funds are like pretty much every other, in that our portfolio companies, those that had rounds that they were getting ready to roll out, or otherwise are looking to do internal financing rounds with existing investors, and or to bring in a new investor or two. because if there's anything that helps a company feel better during a period of uncertainty, it's runway. So, you know, we've seen, I would guess, 10 or probably more like 20 or 30% of our existing portfolio companies that are still in early stage are going back out to the market to try to build additional runway. So deal flow has been strong on the existing portfolio company standpoint, which for many early stage and angel investors has meant their first focus has been on existing portfolio companies, but there are also a number of new deals that have been taking place, and the deal flow has been, I would say, typical to strong in terms of the number of deals that we're seeing. In terms of due diligence, Drummond Road has always kind of focused on relationship investments, meaning the companies that we invest in, we have either been involved with before in an accelerator, or we've had a relationship that we've built with them over a period of time before investing. Although we conduct a lot of our business over Zoom meetings just like this one, because we're investing all over the country, not just in Northeast Ohio. We never make an investment without a personal meeting with the founders, and that has caused us, at least, to take a pause on most new deals that aren't coming from existing relationships.
So let's maybe take that one step further. Rem, to you, leading up to the point where it'd be appropriate, or you might, Jumpstart might otherwise have that in-person meeting, what is Jumpstart doing? What is Jumpstart seeing in the investment community around how investors are getting comfortable with founders? And has that changed? Does it follow the same model because it's being done by Zoom until the time you're ready to have that meeting, or what additional steps are being taken along the way to make those connections?
So probably a little bit too early to know how this is going to unfold. You know, given the work that we do primarily in Northeast Ohio, we know many of the entrepreneurs across this part of the state. We know a little bit earlier stage companies, those that are kind of pending a seed round in other parts of the state as well. Having knowledge of the team and the idea that they're executing on is really helpful. We continue to see deal flow, new deals, as well as companies that we've been speaking with for a while, applying for, you know, reaching out and applying for capital. And we are working towards, you know, building out the process by which we engage with companies and get to know what they're doing, and get to know the founders in a virtual environment. It's certainly easier to do with folks that we know and that we're acquainted with and have spent time with in the past. You know, I don't think that the venture industry is going to shut down because we cannot be within X number of feet of people, and so I don't expect that to happen. I expect that we are going to, we as an industry, and we at Jumpstart are going to figure out how we learn about ideas, get to know the founders, because founders, frankly, are the most important element of any startup, and form the form of relationship that we hope to develop with people over time. So I would say, you know, the process of conducting diligence on a company is fairly straightforward when you know what they're doing. The more difficult piece, I think, at a distance is getting to know the team. But, you know, people generally know how to adapt. I suspect that we at Jumpstart and our peer investors around the state and across the country are going to figure out how to get deals done when they see interesting deals. I don't think the market is going to go on an investing hiatus. We will simply adapt.
So, and I'm going to just keep going down the line. Yvette, can you how have you seen the second or the third time founders react while trying to raise capital? Morris alluded to the fact that there's a strong concentration on raising additional internal rounds. Is that what you're seeing? Is there a greater benefit when those founders have done this before, or really no big difference? Because save for Morris already copped to the fact that he's seen this once or twice before. I have no hair, so I have two, but otherwise, folks who have done it, it's really completely a new and different experience. What are you guys seeing within your portfolio and otherwise?
Yeah, I would say that for founders who are going out to raise either follow-on and or, as you mentioned, our second or third time founders, it typically tends to be a little bit easier. Now that's not the case all of the time, but I think there's a couple of factors to their advantage. I think one, they generally have a picture of the steps they're going to have to go through, and I think they can be proactive and start kind of communicating with those VCs that might be funding their next round. As I think Morris and Rem mentioned, the VC industry is very much a relationship industry. So I think that some of the best, entrepreneurs that I see in our portfolio and that I've interacted with kind of do that. They preempt it, and they're, after they finish their first round of financing, they're out there kind of socializing and talking and building that relationship with VCs that they see could kind of fund their next stage of growth. And I think that helps a lot. So that we always like to say that, when you're asking us for money, it's not the first time we're meeting you. And we've kind of built, whether, we've met in person, we've had calls, we've seen your emails, we followed you, we have some frame of reference, and we're like, oh yeah, we've been able to see his growth, or we've been able to see what the company's been up to. And I think that kind of reinforces our relationship building. I think 100% we're also of the mindset, and we also typically meet the team a couple of times before we invest, but I don't think that's the only way to build a relationship. So again, I think that, for founders that can kind of do that, I think it's great. It establishes familiarity, and it gives us kind of comfort with the company, because we feel like, we've been knowing you for a longer time. I would say that's the upside, that either follow-on, that even first-time founders are raising a follow-on round have, as well as second or third-time founders.
So, Bill, the next step of all of this then is what you're looking at as decks are coming in, or you're being introduced to certain investment opportunities. I mean, given the state we're in these days, has that changed the investment thesis internally? Has it changed what you're expecting to hear from founders? Has it changed something else? What's your perspective on that front?
Yeah, I'd like to, as Morris had said earlier, similar to Morris, I'd been through the couple of the other downturns, with September 11th in 2001, and then 2008, 2009 with the mortgage crisis. I just want to make a couple general points from that perspective. Some of the best times to build companies are in these circumstances. It's very difficult and all that, but it really keeps the entrepreneurs and keeps the whole team very sober in terms of being very focused on making tangible progress. So actually, some of the most successful companies I had out in Silicon Valley were started during the downturns. Dexcom is a continuous glucose monitor company, currently $25 billion market cap. It started in 2002. Another company, Infinera, is a networking company that started in 2007, 2008. So some of the, this is still a good time to build a company from that perspective. And then on the flip side, some of the best exits come a few years after this. We had, there weren't many great exits in 2008, 2009, but by the time 2011 rolled around, there were some great, some really nice exits starting to happen, even within a couple years of the last downturn. So I would encourage people to keep, moving forward. It's a great time to continue to build up a company. What we're seeing right now, the first thing we did in our portfolio was just look at things. We had different companies affected in different ways. Luckily, not too many, kind of made major impact. A few, like a Script Drop, which happens to deliver, prescriptions. With this, COVID going on, is growing rapidly. Aware, that Rem and I are involved with, that's more in the collaboration, security, compliance, and data analytics space, has seen much more activities. People work from home, so we have some of those, good stories. We are seeing, in terms of investment, a reasonable amount of investment. We just announced a closing with Genesis down in a Series B down in Cincinnati, where TDK and another strategic came in. So we are seeing that level of activity. We are going to close on we closed on our second deal in the last 30 days. We'll close on that next week. So we are doing new deals. We do kind of look right now though at the environment. If you're a company being recently impacted by this environment, it may be best to kind of wait off a little bit and just try and get through with the money you have, or try and raise a smaller amount and get to the backside of this, hopefully sometime in the fall. That's what we're doing in some of our cases. Jobs Ohio has a nice program out there for some of the existing Series A, Series B companies that I know that we're in Jumpstart involved with some of our companies, that is giving them some money to kind of get to that progress in next stage later this year, going in next year. But we, as far as at OIF, we're looking at companies similar to how we have in the past. We only do about 4 to 5 deals per year, and the Series A level too. Depending on the size of the firm, most partners in doing Series A or Series B are typically doing 2 to 4 deals a year. And so if you have a partnership of 5, it's just a funnel, right? At the seed stage, you do a lot more, and as it funnels down, you do less. So we continue to be highly selective. We do look at kind of what is, it does give companies that are in the build phase, in terms of not out there with a full sales force, perhaps a little bit of an advantage, because they can take the next 6, 9 months, 12 months to build up your product. We would probably be a little bit hesitant if someone like has a full sales and marketing force, a huge burn going in this environment that doesn't quite fit with COVID, unlike say an Aware or Script Drop, then that could be a little bit more difficult with us. What we're seeing outside of Ohio nationally is probably about a little bit of caution in Silicon Valley, in terms of investment. There still is active investment going on. I'd say very different on the East Coast. I think obviously New York and now Massachusetts have been hit pretty hard. So I think some of the people that we're working with on bringing as Series B or C investors from from New York or Massachusetts are pretty much very cautious. But
So I think that's all really helpful and good perspective. Let me slightly redirect things to the operational side before we come back to talk about some investment terms. But Rem, let's imagine we're 6 months down the road, and you have an opportunity to see, first-time founders. They're raising sort of pre-seed capital. What do you want to be able to see that they've done over the prior 6 months that will show you that they reacted to the environment well, that they made good decisions, that they've seized that opportunity, all of those sorts of things? If you had the chance to look backward at that point, what would be good advice on how folks should be doing things over the course of the next 6 months that would then resonate with you at that point?
So I think it really depends upon the market focus for the company, right? As Bill mentioned, some companies are really experiencing tailwinds as a result of COVID because their technology or solutions are helping to address urgent problems. That's not the majority of companies. So I will speak about these that are not in that category, because I think companies that are benefiting simply need to really identify those opportunities and execute well on them, and the data then would be reflective of the progress that we would want to see. But for companies that are facing headwinds in this time, and that would be most, the things that we would want to see, and the feedback that we're providing to companies that we're speaking with, both that are up and coming for investment and or companies in the portfolio that are maybe seeing, if they're in market, if they're in clinical trials, and the progress both in sales and in trials are slowing down. We're trying to figure out really what activities can they devote time to that will help them create value for the enterprise, and that really varies. And I think really speak candidly, what we know today about the market shakeup is different than what we knew 3 weeks and 6 weeks ago. The benefit that we're seeing right now is that the disruption to virtually every job that's being done is beginning to level out a bit. And we're seeing that companies are now beginning to find some new normal. That's speaking about companies in the broader market as opposed to portfolio companies or seed stage businesses. Seed stage businesses should be assessing what's happening in their market and trying to figure out which ways they can continue to move their idea forward. If they thought they would be selling today, but yet they can't sell because their buyers don't have budget or they're not in a position to make those buying decisions, they should be looking at other markers of validation. So what signals can they gather that show value and importance and for their solution, so that as the market begins to turn around and improve and buyers do resume the purchasing process, they're able to accelerate very quickly. Examples might be to take, if they have budget, and not all companies do, if they have budget, can they do some marketing that would get to people, get on the desk of people who are trying to solve problems. They may not be solving them right now, but they know that they need to solve them as they move forward and their businesses have increased liquidity. So what are the markers that make sense given the stage of a business, given the market that they're targeting, and show that you can move your business forward by learning. So much of a startup is, how do I learn to navigate the uncertainty that every startup faces? If founders are continually focused on the same thing without shifting to things that can help advance their business, they're not thinking creatively. So think creatively about what you can accomplish that's going to be impactful to demonstrate efficacy of your product, value for your product, so that you can take this progress over the next 4 to 6 months and bring that to an investor and say, we thought we'd be in market by June, but we realized the market's not buying, but these are the things that we did to advance our business. Specific to each business, hard to be more specific than that. Through conversations with entrepreneurs, we can sit down and have those conversations, and we're happy to do that at Jumpstart.
So to pull back onto the actual investment side, and Morris, let's go to you with this. Having seen a couple of these cycles previously, can you talk through what changes in investment terms were sort of seen as a result of prior downturns, and then what that really means in comparison to what maybe founders would have or could have expected, and really at the typical angel investor level or the seed stage level, because that is going to set the tone for a series of the balance of their investment activity, and what's going to change now, assuming we follow a similar path from before.
That's a really good question, because I think this is something that especially founders raising money need to understand. There are very few venture firms right now that will not tell you that we're out in the market and we're investing like we always do. The truth of the matter is that these are very uncertain times, and a lot of investors are concerned that things are changing in a way that they don't understand yet, and they want to know how it understands. And what has happened in a couple of the previous downturns that I've seen is, not only has it taken a long time for the investors to normalize what's going on, but it takes a long time for the entrepreneurs. And what I mean by that is, 2008 and 2009, you did not see valuations adjusting as quickly as you might have thought, because every entrepreneur believed that their business didn't warrant a 20 or 30% discount for where it had been a few months before. And if you're an entrepreneur that is focusing on your customers and focusing on your cash flow and doing everything that you can to make sure that you've got runway, you have the luxury of waiting and seeing where valuations come out and where terms come out. If you need money now, then you need to, as an entrepreneur especially, need to understand that investors are going to be more focused on the downside, and you, as a result, need to be more focused on the upside. If you're a company that would have got a $10 million valuation 5 months ago, and you're focused on the upside, getting a $5 or $6 or $7 million valuation now isn't going to make much difference in terms of your ultimate outcome if you're focused on the upside. And my best advice that I could give to founders is internalize the changes, be prepared to focus on the upside, and don't be as concerned with a 10 or 20 or even 30% discount from where you believe your valuation might have been 5 months ago, because in the long run, if you're focused on the upside, it's not going to make much difference. And the key is staying alive and getting the runway that you need to stay alive and through this period, which if you can't do it by adjusting expenses and focusing on existing customers to maximize revenue, you're going to need to do by raising additional funds.
Thanks, Morris. So, Yvette, next question for you. Although I'll remind everybody who's participating with us today, don't hesitate to serve your questions up. We've had a few come in, but and we're getting to them, but please don't hesitate to input them into the, I think it's into the chat feature of your go-to meeting window there. So, Yvette, you had mentioned in response to your last question that you like to say that the first time you see founders isn't when you're going to close on the investment. Can you dig into that a little bit more deeply? Could you give a little bit of advice to the founders on the phone, and in particular those at the earlier stages with respect to the types of things that they can be doing to differentiate, the types of things they should, how they should be adjusting their approach, their asks, etc., in light of where things are?
Yeah. So what I'll say is we have invested, in companies that we've met, for the first time, but typically I think we tend to prefer to have some familiarity with them prior to this. So, we've done both, and kind of advice I would have is, again, kind of going back to really relationships are core to our industry. So what I've seen some entrepreneurs do is, I meet them for the first time, either, kind of cold outreach or someone refers them to us, is kind of go back into your network. And if you can find kind of a common link between, the investor or the group that you're trying to build a relationship with or doing outreach to someone that's either an angel investor, a previous investor, an advisor, or even someone that's seen your growth, I would say go back, and if the relationship is there, tap them and ask them for kind of a referral, or to kind of reach out to someone like me or the investor going out on your behalf, and kind of speak to your character, to your growth, to kind of your business. And that typically, is very well received, at least for me and for my group. Because again, what we want to understand as an entrepreneur in the early stage, our belief is that we're definitely investing in the team, the founding team. And I think, added data points always give us comfort there. So I would say that's one piece of advice that I'd have for entrepreneurs, kind of like definitely rely on your network. I think that most people in today's uncertain world know the importance of that and are there to help you. I know we kind of, talk to a lot of our portfolio and are communicating with them a lot more and encouraging them to communicate with us and kind of, tell us what they need. So I would say that's another piece of advice. I would say over communicate in today's uncertain world. It's better. Don't try to, I would say, paint a rose-colored picture and just be honest and frank. And, I think it was said before, be realistic and say, these are the steps I'm going to take. They're going to be difficult, but this is the plan. And I think, again, for us, that's also a good sign that you can kind of see ahead and, make the tough decisions that need to be made, but also kind of plan accordingly. Yeah, so again, so that's another piece, like over communicate. I think, with current investors or people that you're looking to get funding from, I think that's one of the things that people should be doing today.
So, Bill, similarly, and with respect to potential new investments, so not follow-ons inside your portfolio, but are there, is there anything in particular? One question that came in was, asked for, 3 tangible things that a company could do to, to differentiate itself in this period. And this is aside from your current portfolio, but for new investment opportunities that you're seeing, anything specific that you could lay up for them?
Oh, absolutely. So first, I just quick comment on what Morris had said earlier. The things we've seen so far as differences in valuation, I think there's been some studies out there. Most VCs are saying about 20% down. At one of our companies, we did see a couple of VCs that are looking at it that normally would priced at 10 times ARR are pricing at 6 times, so that'd be at 40%. So I'd say anywhere 20, 30 up to 40%. We have not seen what happened towards the back end of 2008, 2009, which is not only a senior liquidation preference, but a senior liquidation preference with a multiple. Back in that time frame, we had one company, Blue Arc, that actually had a 5x senior liquidation preference put on it. Then luckily we participated quite a bit and got sold in 2011, so it's positive for us. But for those that didn't, it was difficult. We haven't seen that yet because I don't think this is not as big of a fundamental kind of long-term. If you looked in 2008, 2009, it's going to last a lot longer. Just based on the mortgage crisis, everything else, you're a year or two into this. It's a very different situation now, which gets into your question. If I'm looking at a company coming in, a new company, I'd be looking for number one, what have they done since this happened to address the market? And that gets down to a lot of companies should be looking at reductions in salaries. What can we live on? As far as the management team, as far as the employees, we in a lot of cases, replacing, providing some extra equity, extra options in case, until to get through the next 6 months. We look for them to be taking this very seriously from a company perspective in terms of their burn rate. As Rem had said, really looking at every dollar very carefully. How are we investing each dollar? So we want companies that really are taking this seriously, have taken steps in terms of operating expenses and salaries and everything else, are looking at every dollar very preciously in terms of the investment, and then really looking at telling us, okay, over the next 6 to 9 months in calendar year 2020, with the money we'd bring in. And I would not go for, it'd be nice to be funded through all of our existing companies. We'd love to be funded through 2021, but as far as a new company looking at it, what can we accomplish on the least amount of money in 2020, perhaps into 2021? There are some really tangible value creators. And I'd have those very specifically, almost like 3 to 5 bullet points. If you give us $2 to $3 million, we can achieve A, B, C, D, and E. And here's how we're going to go about doing that very, very tangibly. I don't think this is a time for vision. I mean, vision is important, but if you're just talking vision and opportunity, and when this all turns around, it's all going to be fine. I mean, we want firms that are taking this very seriously, that understand the environment they're in, and have adapted also their business model to this environment. And I'm not saying, I'm using an existing company as an example, but Rem and I are a company called Complion that does SaaS for clinical trials. Instead of using binders, you do it in software, allows for better workflow, compliance. You're not dealing with binders, more efficient. There are still clinical trials going out there for COVID, so that's a positive. A lot of clinical trials have been delayed. So what did they do? Well, they're pivoting their business to some extent with their software allows CROs to do, to be much more efficient. They can achieve, every person they're kind of looking at compliance in a clinical trial can do it 4x more, with their software, and they can work remotely. So we'd be looking for companies that have taken this seriously from operating, a structure perspective, from a burn rate perspective, really, justifying each dollar, have adjusted their business model to reflect the current conditions, and then have, a handful of very tangible milestones that they can create on the minimum amount of money possible.
Thanks, Bill. So, Morris, let me pull back to you in thinking about whether, in Compliance is a good example, and I know that, previously we talked about share and script drop, but what are some other ancillary types of businesses or models that you think, as a result of what's gone down over the course of the last 3 months, you'll start to see growth around? And why will those things, aside from the fact that they involve delivery and everybody's stuck at home, why will those things be the blue jeans to the gold rush in this instance?
Well, I think the most important thing, as a general takeaway for all companies, regardless of what market you're in, is the days of having a product that is a nice to have that you can sell are over. It's time to make sure that you are essential to your customers, because right now you're not going to get any attention from anybody unless you're essential to your customers, and selling's going to be difficult without that. That being said, if you have customers, focusing on customer retention is absolutely essential. If you need to discount to keep a customer, to keep revenues going, and to renew a contract, then do it. And I think that's very important. Now, that being said, we basically in our portfolio have, I'd say, 3 categories of companies right now. There's those like Cleveland-based Within 3 that make collaboration and information management software that primarily has been in the life sciences industry. They were growing by leaps and bounds before COVID because collaboration, information management, asynchronous information sharing, even without COVID, was becoming incredibly important. And they're growing even faster now with COVID. And I'd say that's kind of at one end of the spectrum on our portfolio. At the other end of our spectrum is we've got companies that were remaking the travel industry. Their revenues have all but dried up. And they're focused on capital preservation, extending runway, not spending any money unnecessarily on marketing that's not going to do them any good right now, but digging in with their customer base, figuring out who might churn and why, and spending time with their customers to understand even more their customer needs, so that now that they have extended runway, they're using that time to try to make their product offering even better while they fight to survive. And I think those are the 2 keys. If you've got a product that is essential to your customers already, then focus on your customer base and retaining them, and focus on hearing what they have to say and improving. And if you've got a product that isn't essential to your customers right now, extend your runway and figure out how to make that product an essential offering.
Thanks, Morris. So Yvette, I'm gonna pick on you a little bit. I know that normally you are located square in the middle of the country, but this morning it's very, very early where you are, way out west. And so could you talk a little bit about what types of opportunities, in along similar vein of what I put to Morris, what are the things that you expect to see, whether it is where you spend most of your time or whether it is out west, blow up as a result of where we are now, or see such significant amounts of increased traction that now they are things that will really get investors excited, whereas before they just weren't nearly as sexy as something else might have been.
Yeah, I would say to start off, I would echo Morris's point on the importance of companies that have a solid ROI to their clients and are needs to have, versus, I say, fluff. I think all the fluff is being slashed as budgets are being slashed. So first of all, I think I'd say there's some industries and startups that were not as sexy, as you mentioned, because they were just an accounting, right? Versus maybe an AI startup in the marketing industry might have been a little bit quote unquote sexier. But I think, the marketing budgets are being slashed, startups or Fortune 500 companies. So that I think is one. Industry wise, I think, I don't have the experience that Bill and Morris have from, going through the 08, but I think there's been a lot of speculation, right? That this time is opening up new customer behavior, which is good for adoption in some startups that are having trouble penetrating into their industry. So we always say that customer behavior is one of the toughest things sometimes to change if you're selling into an industry that's not used to it. So within that, I think ed tech is an industry that's poised to, I think, do very well coming out of this. I think that there's been a ton of technologies out there already, but it hadn't been as, let's say, mainstream, right, or as needed. Versus, I hear from the K through 12, I hear from universities that they need a solution, and I've seen some entrepreneurs kind of pivot their offering. So their offering they sold into hospitality, and travel and schools, and obviously the latter two, hospitality and travel, are down. But they're saying now we're going to focus on selling into teachers and into online classrooms. And I think going back to, I think this was said, those entrepreneurs that can react in general are always great entrepreneurs, but especially important in today's uncertain times to react and kind of see the opening and see that some industries are going to have a bigger opening for the product, and to take full advantage of it, to kind of know their customers and see things that are changing within the industry that they can automate, or they can create efficiencies, or they can kind of fill an issue that was always there, but people had to slow down, right, to be able to kind of do that. And again, I've been seeing some startups in the ed tech world that are doing that, and even in some kind of more paper-based industries. So law firms are one. Jonathan, I'd assume you'd have an opinion there, but I think that entrepreneurs that can do that and can say, like, okay, before my customer wasn't doing that, but now obviously the face-to-face and the office, a lot of those things are going to have to go to the cloud, right, or go online. So I think that there's a couple of industries that are poised for that, but I think I've definitely seen cybersecurity as well, as was mentioned, and employee kind of engagement is another one. Now, as we're kind of all distributed, there were some companies that were already doing this and doing it very well, but I think there are also a lot of companies that never had to grapple with it and now are having to and are drinking from the water hose. So again, I think it kind of comes down to sitting down and kind of entrepreneurs know their product and know their customer, and really kind of thinking of what are some additional features or things that we can do, or things that we can highlight, right, that will be useful in this kind of going through this working remotely and having to have some interaction via an online platform.
Well, for whatever it's worth, hopefully it'd be great if some of this speeds up some of the ed tech sales cycles on the one hand, but on the other hand, as someone who's now intimately familiar with Google Classroom and is the at-home IT guy for my 8 and 10-year-olds, daily Zoom meetings, I think that there's definitely opportunity on that front, certainly for improvement. Rem, let's bother you with this next one. Do you anticipate, as we start to come out of things and you're looking at pre-seed investment opportunities, let's talk about it at that stage, and a lot of the questions that we're getting here relate to, as all of you might imagine, sort of new investment opportunities. Do you think that investors will be looking for more, whether it's revenue or traction, adoption, or will they be adjusting their own terms accordingly? So, or will it be both, or will it be neither? What's your thought on that?
I can, I guess I can speak on how we're thinking about it at Jumpstart, and maybe share just observational perspective, and that I think Bill has already spoken to a bit too. We continue to look for interesting ideas, and I think the way we gather information around the idea, the problem that it solves in the market, and the evidence of that, given that potentially in some cases the entrepreneurs need to be figuring that out through a very difficult phase. We'll continue to look for companies that are creating value. Yvette spoke to a few opportunities, as did Morris, where there are new opportunities in the market today that didn't exist, that were not priorities for companies just 60 days ago, and they're very quickly becoming priorities. And if companies are solving problems in important areas that are not specific to COVID, but are maybe forced by COVID, that have the potential to continue to be important as we return to some form of normalcy, I think those are going to be really interesting opportunities. I don't think, I don't see a reason why terms really adjust at the seed stage materially. That might be different if we're talking about a follow-on round for a company that's been in the portfolio that hasn't been able to perform, that hasn't been able to raise easily, there might be a different discussion on terms. Generally, terms are not the most important component for a business that has opportunity and performs well. So generally for us, the conversation doesn't start there. We are continuing to look for companies that are solving important problems in the market. We are meeting with companies, and I know we've had in the last week, I think at least 3 that I've been part of. And I think that there's going to continue to be opportunities for founders to get funded. Yes, the process of running diligence, getting acquainted, learning, and becoming what we like to call partners. This is a partnership business. Is going to be a little bit different than it has been. We'll need to figure that out. As for more broadly, post-seed follow-on rounds, we've seen a mix. We've seen companies that have had term sheets pulled, and prior to those term sheets being pulled, we've seen the terms of the investment ratchet down. I think this is really going to be, I think that the funding environment is in some ways becoming a buyer's environment, but companies that are performing well are going to continue to get funded. Companies that are trying to achieve that product market fit, validation of efficacy, need in the market, are going to need to continue to prove their value every day before they raise around that evaluation that they like. I think we've talked about earlier in the conversation, good companies will get funded. Valuations may not be where we thought they would be maybe 90 days ago, but it's important that founders continue to push their businesses forward as the opportunities exist. I wouldn't get really hung up on valuations within a relevant range. Keep funding your business, keep driving forward, and build a great business. That's the best way to achieve success.
So, Bill, a slightly different direction. What about the size of the round? Should companies be looking to increase those? I mean, everybody has said sort of for follow-on rounds that are in the works, all things are still a go. Does it make sense at this point to increase it by, some even modest, or if not modest, significant percentage, or is that too reactionary and they should stay the course and try to make do with the plan that was put forward at the outset? What are your thoughts on round size?
To a large extent, I think that's going to be determined by the opportunity set. If someone has an opportunity to add on $3-5 million to an existing to a round being raised, a Series A or Series B, I would do that just to provide perhaps runway instead of through 2020 and into 2021, kind of through 2021 into 2022. But that's more a philosophical thing on my point. I mean, as long as you are, not wasting money, and such, I always prefer our companies to raise more money because it just allows for, you never know what's going to happen, allows for more pivots, and just a longer runway to, make progress and make things happen. So I think if it's there, but I wouldn't be prepared for that. I'd be prepared for, okay, on a very, prudent, thin budget, what can we achieve over the next 12 to 18 months? And I go out, and then if you happen to be able, if you're looking for 3 to 5 and you have the opportunity to close on 6 to 8, that's great. But I would not go out there with big grandiose dreams, because I think it just doesn't seem, if you're talking about we're going to grow from 20 people to 60 people next year and do this, that, and the other, I'd be like, okay, these people haven't been watching the news. So I would definitely go in with a very kind of sober, okay, here's what we need to achieve these milestones in the next 18 months. Like Rem said, as long as it's a reasonable valuation, just get the thing closed. Because the long-term, a 10%, 20% difference is not, in valuation, not important. It's just getting the money in. And then if you happen to get more interest, oh, well, geez, I talked to Rem and I talked to Bill, and both are interested at this level. Can we put them together? I would definitely do that. But I would go out with a very prudent, streamlined plan that achieves quite a bit on the most, kind of least amount of capital. And then if that attracts more interest, then I would bundle as much together. But I think the time, unless you're in a unique situation like Yvette and Morris give some examples, a la a script drop where you're growing hundreds of % every month, that's great. But that, as Rem had said earlier too, that's the exception, not the rule in this environment. So unless you're in that situation where you can really, then I would go for something big. Otherwise, I think that would just really turn me off. Someone walking in and saying, okay, we've raised $3 million in seed capital. Now we're raising a $15 to $20 million Series A to take over the world. It's like, all right, nice to know you. Have a good one.
I think a hand was being raised somewhere else on the board. Morris, yes, Morris.
Yes.
You have a couple
So
thoughts?
I want to agree very much with what Bill said about being capital efficient, because that is going to be a big draw for investors. But it's also going to be important, especially in the context. I don't know if any of you saw some of the data that Ed Buchholz of Start and Clee had put out recently, but his data suggests that Ohio companies are giving up far more as a percentage of their company in early rounds than in other places in the country. And I think that's really important, because absolutely extending runway is the most important thing that you can do right now. However, there's got to be a bound on how much you're raising, because if you give up 30% of your company by the time your seed stage is done, when other companies are giving up only 10, 12, 15% by the time their seed stage is done, then you're going to be at a disadvantage to those companies. And I care about that, not only because that is a success factor with founders continuing to have the right amount of upside in terms of ownership, but it also harms me as an early investor, because let's assume a company that gave up far too much in early stages is now going gangbusters and is going to have a next round that is going to be a very good round. Often what's going to happen is the later investors will try to fix the low percentage ownership by the founders, and it's going to be taken out of the hides of early investors. And I think especially, founders should be looking out for themselves, but also should be looking out for their early investors. So I would just caution a little bit about raising there is such a thing as raising too much money if it is going to hurt you in the long run strategically.
Well, and I do think actually those two things fit together well. Rem, there have been a few questions about looking for suggestions to diverse founders on what they can do to further distinguish themselves, to make up the gap that's there already. I mean, do you have recommendations from where you sit and what you've seen for those folks to be able to try to pull ahead, or at a minimum get an opportunity to present at this stage?
Yeah, so not quite sure of the entire context of the question. Obviously, raising money is difficult. It's difficult for every founder, especially early on. Some founders have the ability to reach into a family and friends network and fund early on. We know not all do. Diversity and inclusion is really important for Jumpstart. We're so devoted to it that we have a $10 million fund exclusively for diverse founders, African American, Latinx, female founders, and we work really hard to find great diverse founders to help solve the problem of underrepresented populations in the venture community. So I'll go back to saying, we're here and available to have conversations. We want to hear about your ideas. We want to get to know you. The challenge of raising early capital, it always exists. And it's very situational. So I can't answer specifically to the questions that each individual may have, but we are here and available to help have those conversations, give advice if you're kind of at the pre-seed stage on how we might navigate that process.
Thanks, Rem. All right, so we have about 5 minutes left. I'm gonna just go back to each of the folks on the panel and just to ask you for a key takeaway. I'm gonna start with Morris and then go Bill, Rem, and end with Yvette. So Morris, a key key thoughts on what founders should be thinking about in this environment, what they should take from this panel or otherwise. Your final thoughts. 30 seconds.
Customers, 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 product market fit.
All right. Bill, he just got you 24 seconds on top of your 30. If you choose to use them, feel free.
Didn't give me time to think, but just reiterating what I said before is when you come in for a Series A, be very obviously you've been in because that's where we focus on some answers on the Series A, but you've been in business for a while. You've gotten a seed or a pre-seed and a seed, or a pre-seed, a seed, a seed plus. You've had a business model in place. I'd expect you coming in to have really rethought that model in terms of how you've adapted your operating structure, your go-to-market structure, your messaging, your customer targeting, what you're even offering, what your product roadmap looks like to the current environment, and just can't overemphasize enough what Morris said earlier. Nice to haves, pretty nice to haves, really nice to haves. It has to be a must have in this environment. So you really have to say, in this environment, this is really a must have for these reasons. Keep it very simple, and please let us, for over the next 12 to 18 months, have 3 to 5 tangible things that are very easily understandable value creators for a reasonable amount of money that you're able to achieve. That would be my advice for going in a Series A round. Less about some about the vision, obviously important, but really about what you're tangibly going to achieve with a must-have product or service offering over the next 12 to 18 months.
Rem, your key takeaways.
Yeah. So key takeaways are, these are definitely tough times. You've heard that story. You know it. You're living it today. Be conservative in your planning. Figure out how to stretch every dollar. Reduce unnecessary expenditures. And I say, at a point like this, you probably can't over communicate. You can't communicate too much. So you want to be communicating with your team, with your customers, with your partners, and with investors as well, if you have them. If you don't yet have investors, those that are up and coming and on your horizon for investment, you want to be communicating with them. What investors like is they like to track progress. So there's no reason why, if you are engaging with investors and they've expressed an interest and they want to know what's happening in your company and they may not be ready to write a check now, there's no reason why you can't keep them informed. So when you want money, ask for advice. Is good feedback. So if you know you're going to be raising a round, you want to talk to investors, ask for advice, ask for feedback, get their engagement, and take that feedback and continue to factor it into how you're executing. We all are working incredibly hard to get through the next X number of months, and I think founders' ability to endure and to maneuver in this really difficult time is going to be a testament to their desire to survive and push through really significant challenges.
All right, Yvette, it all comes down to you.
Oh, thank you. I would say entrepreneurs need to shift their mentality and their mindset from hypergrowth to survival. I think it's been said during this webinar that you need to outlast your competitor. And I think that's the biggest thing. You need to outlast that competitor, and path to profitability is going to be a lot more important in today's temperature and today's climate, as well as paying attention to good kind of unit economics, because you the limited resources and limited money that you have to make last. So I would say that's the biggest thing that has to happen, kind of shifting that strategy to survival versus just the vision or the growth.
All right. Well, thanks to all 4 of you, and thanks to everyone else for attending. And thanks again. Have a good day.